And that is our top story at 6. The housing market is once again the main reason that the stock market suffered another big loss today. You can see here that the Dow Jones dropped 200 points, closing at 13,028. The sell-off came after big retailers Walmart and Home Depot said their sales are being hurt because the subprime mortgage meltdown has their customers reining in their spending. That trouble in the subprime mortgage market is spilling over to buyers and homeowners with good credit as well. KRON 4's Maureen Kelly has more on who's going to have problems getting a loan in this real estate update.
Skittish investors feeling the sting of the subprime mortgage backlash are the reason that the money pipeline that flowed freely into the Bay Area real estate market is being slowed to a trickle. There are still loans available, but if they're jumbo loans, that is over $417,000, they are very hard to get.
If you were putting 20% down, you would have no problem if you qualified for the loan. The problem is qualifying for a loan with kind of a standard income in San Francisco. It's almost impossible to do full doc.
Full doc is short for fully documented. That means you need to provide paperwork showing your job history and income for the past 2 years. This can be very hard for people who are on commission, like salespeople or those who are self-employed. First-time homebuyers should also expect to have a tougher time getting a loan.
A lot of people who are first-time buyers, and they're getting in at the $800,000 to $1 million range, and they don't have $200,000 sitting around to purchase a house.
People who've sold their first house before they bought their next one are in better shape. But those who want to buy before selling can expect to run into trouble because lenders want to see the equity out of your house and into your bank. Even if you do have cash on hand, expect to have even more than the 20% down payment in reserve. Lenders used to be okay with the borrower having 2 months of mortgage payments sitting in the bank. Now they want to see 6 months in reserve. The other problem looming in the mortgage industry, homeowners with loans about to go adjustable who didn't put much money down and who want to refinance, but their home value has slipped.
Well, it certainly could hurt refinancing. Those people who did 0 down or 5% down, if there are price adjustments, there'll no longer be equity that they can refinance into. Those people who are having adjustments coming on their rates will not be able to see the benefit of a lower rate at this time, so that's going to be a problem too.
In San Francisco, Maureen Kelly, KRON 4 News.